And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's The Real Investment Show, and it's Thursday, second best day of the week, of course, as we get ready to wrap up this already holiday shortened week. Already kicking off the new year. And we got the Santa Claus rally finally showed up. Now, the Santa Claus rally technically lasts 5 days of the year, first 2 trading days of the new year. Yesterday, got a little bit of a rally. Now, look, it wasn't much, and we're clinging to straws here, but market did rally about 70 basis points yesterday. Again, as we talked about yesterday, and this is also in today's market commentary as well, our daily commentary we put out in the morning. Markets just really trading along this very defined consolidation range, and it's been very tight here for the last couple of weeks. We talked about this yesterday a bit. Again, lots of things happening here where markets are trying to hold up here despite the fact that, we've got the Fed. And again, Michael Lebowitz joining me this morning. We'll talk about what the Fed FOMC minutes said yesterday about rate hikes. Nil Cash Carey out yesterday saying, yeah, I think we're going to hike rates another 1%. That would take the Fed funds rate to 5.5% from here. Of course, no real sign, and this is something that we'll get into more detail, but no sign the Fed's going to pivot anytime soon. But markets pricing in rate cuts as soon as July. So again, markets are trying to expect the Fed to start cutting rates. But again, markets holding up here. Now, as I said yesterday, kind of the good news, markets are trying to establish these higher lows. Of course, we've got these higher lows. We also have this downtrend line that goes all the way back to the beginning of last year. So that trading range is getting a lot tighter for the market. So the market's going to have to come to a decision point here sooner than later. So at some point, the market will have to make a move in one direction or the other, a breakout to the upside of this consolidation range and this tightening kind of wedge pattern that we've got going on right now. Would signify a move, substantial move higher. We're talking probably a 5 to 10% move higher if we can break out of that consolidation range. If we break below that, of course, we're going to be setting new lows, and of course, that's not what we want to talk about this year. So, after last year, we want to talk about higher asset prices. But let's talk about that for a second. Market does break out to the downside of this. Now, that wouldn't be surprising given the Fed still hiking rates. Now, normally what happens historically, markets tend to soften as the Fed continues to hike rates. Once the Fed actually pauses their rate hikes, that's where generally the market is either going to say, okay, everything's fine, and markets are going to start to stabilize, or as we saw in the year 2000, when the Fed began to pause, that's where markets really started to accelerate on the downside. Also in 2008 as well, the peak in those rate hikes was the beginning of the bear market. So again, it's kind of a nix of where markets are going to behave once the Fed actually does pause. The question is, and really the defining differentiator is the economy in a recession when the Fed pauses? That's going to be the defining answer to how markets perform. Of course, this all comes down to earnings and estimates and those type of things as well. So again, lots of exuberance here really kind of from the market, hoping for these kind of Fed pivots. We go from one meeting to the next. Is the Fed going to pivot? Is the Fed going to pause? What are they going to say? Every meeting, the Fed comes out and says, we're not pausing. We're going to keep hiking rates. Markets get into a bit of trouble here, and then try to rally into the next meeting. We've got another meeting coming up in February. That'll be the next rate hike from the Fed. Quarter basis point is expected in February, and then we'll 6 weeks, after that for the next meetings going into the summer. One other piece of good news here, sort of, is that our MACD, which has been a very good indicator this year for risk management and removing raising cash or reducing equity risk, however, depending on where the markets are. That is very close to actually turning positive here. So now the unfortunate part of this is that it's about to turn positive from only coming down about halfway. So when that occurs, it's typically not as good of a signal to be making a buy decision. We might get a tradable rally here back up towards that 200-day moving average right around 39.90, which is, say just call it 4,000 on the S&P. 3,900, as we talked about yesterday on the S&P, not too far from here, a big convergence of moving averages right there. So lots of overhead resistance. Markets are going to really have a tough time initially kind of making a move higher unless there is some piece of good catalyst here, right? Some piece of economic news, a pivot, some type of, mention from the Fed that maybe they'll slow down the pace of rate hikes sooner than expected. Don't see that coming, but you'll need some type of pretty decent news to push through all that kind of cluster of moving average resistance. But again, when the MACD is at such kind of this mid-level, it's not as good of a signal because we'll very quickly move back into overbought territory. In other words, the market won't have to move much to get us all the way back up into kind of overbought regions. So again, just be a little cautious here. This has kind of been the message all of last year, and unfortunately, it looks like it's going to be that way this year as well as we start out the year. Be a little bit more risk averse here. Control your risk exposure. There's some opportunities here in the markets. Obviously, for taking on some risk, we were talking about recently, taking a look at energy stocks as well. The market itself in terms of energy stocks is deviated from what's actually happening with the price of oil. So yes, energy stocks have come down, but a lot of the majors haven't. ExxonMobil, Chevron, et cetera. Those haven't really come down much despite the big decline in oil prices. So there might be an opportunity later this year if energy stocks catch up with oil prices being lower, might have a better entry point to actually add some energy exposure. Now, some of the drillers have already had fairly big corrections, so there's some opportunities to kind of dig through that sector. Gold, on the other hand, has had a very good run lately, and this has been one of the kind of the interesting aspects. Gold has had a very big move here, getting very extremely overbought. So again, if you've been long gold, this is a good opportunity to take a little bit of profit out of that position. Probably going to get some weakness in gold prices here sooner than later, depending on kind of some of the economic data that's going to be coming out here sooner than as we kind of go forward. So again, nothing wrong with the position, just very overbought. Take some profits, look for a pullback to probably around 1,700, 1,725 to maybe make an additional purchase of gold. So again, just there's some opportunities that exist, but as we kind of go through the year, we'll have to just kind of cherry pick those opportunities as they come along because, again, until we really have a direction from both the Federal Reserve in terms of what's happening, most importantly, quantitative tightening, something Mike and I will talk about this morning. The headwinds that are going to be plaguing the financial markets really most of this year all come back down to the Fed. Yes, we have weaker economic growth. Yes, earnings are going to be an issue. Valuations are still an issue as well. But ultimately, what's going to drive the market is the Fed, unfortunately, because this is what we've come down to. We're now solely dependent on the Fed, monetary liquidity, and the direction of interest rates for putting capital to work. So again, lots of headwinds that we've got to deal with, of course, going forward this year. So it'll be a year where we're going to have to be trading a lot more rather than kind of buying and holding. So, we could very well end up this year kind of flat to even slightly negative, might even have a slightly positive year, but it'll be a volatile year nonetheless. So the way to make some money this year is probably going to be trading opportunities as they show up. Okay, so having said that, we've got a lot of stuff to get into this morning with Michael Leibowitz. When we come back from the break, we'll talk about the FOMC minutes that were released yesterday. Futures are about flat this morning, not a lot going on here. So we'll see how the market digests this news from the Fed. And again, as we kind of really start to set out the first 5 days of the year, what is that going to mean for the month? All that's coming up right after the break. I'm your host, Lance Roberts, for The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you as worried about estate taxes as we are? Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon, with the ins and outs of family limited partnerships for your estate and tax planning. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. So yesterday I was telling you about the travel travails of our annual ski trip to go see our my wife's cousin Dwayne, right? Our liberal listener, right? Who has now given us his own version of a bobblehead to hang out here in the studio this morning. So we appreciate you. But I forgot to tell you this one very important story. So I met a gentleman named Brent.
Really?
Yeah. So we're in the Utah. We just landed in the Utah airport, right? So Salt Lake City, right? Salt Lake City Airport. And so we're trying to get down to the area to get our rental car and, to go where we're going. And so we're walking through the airport. My wife and the kids are in front of me, just a little bit. I'm behind them. And all of a sudden I hear this, Lance Roberts. And right in the middle of the airport, right? I'm like looking around, like, what the hell? And there's a guy walking towards me with his hand out. Yeah. And he's like, Lance Roberts. And he says, I listen to you all the time on the air. And his name was Brent. So Brent, thank you very much. He was on his way from Denver hooking a ride through Utah. He got delayed on his flight, hooking a ride through Utah to get back home to Houston. So Brent, thanks for saying hi in the airport. Met his wife and his son, who goes to A&M, by the way. So all good. Yeah. So, but here's the best part of the story. So my kids and my wife are ahead of me, right? So I stop and I'm talking to Brent for a few minutes, and my wife's rolling her eyes because this, every time I meet somebody, I start talking about stuff.
My husband, the star.
I know. Well, this is the funny thing, right? So my kids know that I do radio, but they really don't have any connection about the radio show. They don't listen to it or anything else, right? But they're all ate up with this whole social media, YouTube. They all want to be YouTubers and video superstars, whatever.
Their dad is a digital celebrity.
They want to be influencers, right? So now all of a sudden this guy sees me in the airport. One guy, by the way, one person. So now my kids think it's like, oh my gosh, my dad is like
famous.
He's famous, right? Yeah, it's awesome. He's famous. So, right, I was like, yeah, just go on. This is no big deal. Let's just go get in the car. So we get in the car, we go and we're starving, right? We haven't eaten since morning, and so the kids are hungry, and so we're on the way in, and we find a Red Robin on the way that's just right off the highway heading to where we're going. So we pull off, we go into Red Robin. It's packed.
Really?
It is packed. There's people sitting around everywhere waiting on tables. And so I walked up to the manager and I was like, hey, look, I need a table for 5. And, I said, we're starving. It's been a long trip. And he's like, hey, no problem, man. I got you. And
So everybody else is like, people are coming in. He's like, yeah, it's going to be an hour and 45-minute wait. At Red Robin, mind you.
Red Robin?
At a Red Robin, hour and 45-minute wait. He comes over. We've been there maybe 5 minutes. He comes over to me. He's like, come on, I got you. And he walks in, puts us in a private room at Red Robin. Now my kids are convinced, oh, my God, my dad's a celebrity.
You know you've made it when you're an A-lister at
Red Robin. Exactly. So you have made it to the top. So now my kids are completely convinced.
Oh, yeah.
Yeah, they're still not listening to the radio show, though.
Wow.
Anyway. Michael Leibowitz joining me this morning to talk about everything Fed. Of course, yesterday, the Federal Reserve released their FOMC minutes and some interesting comments coming out of the FOMC. Now, the markets didn't really pay much attention to it. Initially, the markets kind of rallied out of the gate when the FOMC minutes came out. Markets sold off. We rallied a little bit into the end of the day. Again, I wouldn't read a lot into these daily gyrations of the market as of late. A lot of this is repositioning for portfolio managers going into the end of the year, coming out of the end of the year, wanting to have the right positions on their books or not have positions on their books, depending on what their views are. But the minutes were fairly interesting, so let's get into that this morning here a bit. Talk about what the Fed said, and also too, I want to talk a little bit about what Neil Kashkari said as well, because this all kind of plays into the Fed messaging, which was also released yesterday by Nick Timrose. So, Mike, good morning. Welcome to the show. How are you?
Good.
Good.
What a pleasure to be with the King of Red Robin.
I know, right?
Wait till my kids find out.
Yeah, when you can pull that card, let me know. So, hadn't happened at Whataburger yet, let me tell you. Anyway, Mike's going, Whataburger, what's that? It's a Texas thing. Don't worry about it.
I figured it out.
So yesterday, the FOMC released their minutes. Now, this was the minutes from their previous to their meeting in December, by the way. So, we've already had the meeting in December. They raised the 50 basis points that we all knew was coming. And this is the minutes. Now, understand that these are not actual minutes, right? So, and what I mean by that is if Mike and I had a corporation, right, and we had a meeting, a board meeting, we had a secretary sitting there to take the minutes of the meeting, she would write down exactly what we were saying. And that's not what's happening. This is basically very curated notes around the meeting, which basically just back up their statement that they make. But what actually gets said in the boardroom of the Federal Reserve, you're not privy to that data. So these are very curated notes that come out. But it was interesting yesterday, Mike. I mean, the Fed was pretty clear. We're not cutting rates anytime soon. There's no pivot on the horizon.
Yeah. So there were a few takeaways I had, and maybe the most important was that the market and the Fed are in disagreement. So the Fed was very clear, both in the statement and then afterwards with Neil Kashkari. The Fed is saying that they're going to bring rates up. There's still a range of where they think they're going to bring them to, but they're going to bring them to, say, 5.25. Neil Kashkari thinks 5.5. We think it's Bullard that thinks they're going up to almost 6%. But regardless, they're going to bring them up, and they're not touching them. They're going to be there. The whole FOMC committee agreed that rates will be at whatever that terminal rate is for the remainder of the year. The market thinks that rates will be brought up a little bit less than where the Fed thinks they'll be brought up, but the market thinks the Fed will be easing in the back half of the year. And I think what's both, you can think about this two ways, whether it's constructive or concerning. That the market yesterday was up, I want to say S&P was up 30 or 40 before the Fed minutes. It fell quickly. Sorry, got a frog in my throat. It fell quickly, but it stabilized, and the market finished up on the day.
Well, and I think and I'll give you a second to clear your throat. I think it's very interesting here because what's actually happening is again, this market's running on this hope, right? And we've been doing this all of last year, between one meeting to the next. As soon as we have the meeting, then the market starts going, okay, well, now we're going to pivot, and the next meeting we're going to pivot, or the Fed's going to cut start cutting rates, and the market runs up. And what's interesting is that's exactly the opposite of what the Fed wants to have happen, right? Because when the market increases in value, right, or prices go up, it eases financial conditions, which is exactly the opposite of what the Fed's trying to achieve, which then means the Fed has to come out and slap the markets back down again. We saw that in August of last year. We saw it in December of this year, as well as the Fed going, hey, stop running the markets up, because that's you're hampering what we're trying to do here in terms of getting inflation down.
Right. But the market stabilized. So it's almost like the market wants to disagree with the Fed, which is fine. Except there was one statement in the minutes yesterday, and it's a statement we've heard a few times, worded slightly differently, and I'm going to read it to you. Participants noted that because monetary policy sorry, I should probably put my glasses on. Participants noted that because monetary policy worked importantly through financial markets and unwarranted easing in financial conditions, especially if driven by a misconception by the public of the committee's reaction function, would complicate the committee's effort to restore price stability. So to summarize, what they're saying is, if the stock market rallies because investors think the Fed is going to pivot, because the Fed is going to lower rates, that would reduce the Fed's ability to get inflation down. Right. So what the Fed is saying is and I think really what they want, and they'll never say this, they want a controlled burn in stock prices. They want lower stock prices, but not low and quick enough to cause a panic. So the question is, how do you engineer lower stock prices? And it's through liquidity. Mm-hmm. And the title of our commentary, I think it was yesterday, was QT, the elephant in the room. And basically that talked about QT and how it sucks out liquidity. But that's just one part of the equation. The other part of the equation is the Fed also has a repo program. And by those rates, the rates that they offer in money market investors, so overnight investors, these are institutional investors, the rate they choose determines how much money goes into that program. So if they choose a very high rate, a lot of money flows into that program. That's money that's pulled out of the market. That pulls liquidity. So the combination of these two programs, QT, which is on a set course of $95 billion, and the repo program, help them reduce liquidity, increase liquidity when it's needed, and basically probably try to keep stock prices flat, if not lower. And, you could say this is a theory, but we can also go back to, I believe it was 2003. Ben Bernanke wrote a whole speech on this, and the interaction between stock prices and the ability of monetary policy to do what the Fed wants it to do. And Powell and Bernanke are talk all the time. So I think this is just rooted in what the Fed's been thinking for the last 20 years, that stock prices affect the economy.
Yep, and we'll come back from the break. We'll pick up on this a little bit more because, again, the risk for the Fed is prematurely easing financial conditions. And we'll talk about the impacts of that and the impact on the market when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you as worried about estate taxes as we are? Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon, with the ins and outs of family limited partnerships for your estate and tax planning. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife's traveling. She's in Quebec right now for work. She called me up. She goes, everybody speaks French up here. I go, yes, honey. They're a French colony. She goes, I never knew that.
The Real Investment Show podcast. Same show, your schedule.
So the company that she's with took her out to dinner last night. They go to this very nice French restaurant. The appetizer comes out, which is bagua. She goes, that's duck liver, isn't it? Yeah, the rest of the dinner was downhill right from there. So
at realinvestmentadvice.com.
And the only thing that made it better was when they brought the snails out.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon. Register now at realinvestmentadvice.com.
You're listening to The Real Investment Show.
You know, karma is a real thing. So Thursday. So Tuesday.
Yeah.
My wife is telling me, she's like, hey, I'm gonna tell everybody at work tomorrow that I've got to go down to Port Arthur to meet with some clients because there's a couple of houses that I want to go get with our realtor on to go take a look at because she's in a serious house hunt right now. So
in Port Arthur?
Yeah, she's got clients in Port Arthur because they do bunkering of LNG.
Right.
Right.
But she's looking for a house in
No.
Port Arthur?
No. She's using that as an excuse. I'm going to go see my clients in Port Arthur. I've got to be out of the office all day to go see my clients in Port Arthur.
Right.
And that way she can sneak off to go look at these houses, right?
Exactly.
And so she came home last night. She goes, you are not going to believe what happened. And I was like, well, what happened? And she goes, well, I told everybody in my office today that I've got to be down in Port Arthur tomorrow, supposedly today, right?
Yeah.
So I could go look at these two houses that I want to take a look at. And she goes, my clients from Port Arthur called me. They want me down there tomorrow. If you put it out into the world,
Yep.
karma's gonna get you. She goes, I can't break the rules for anything. She's this massive rule follower, right?
By the book.
Everything's got to be by the book. She never breaks the rules. And the first time she's gonna try to break the rules, karma bites her.
She never skipped school, did she?
Nope. Yeah, she doesn't do it. I'm serious. If there's a rule or a guide, right? Yeah. She does not. But I'm like, honey, it's okay. Everybody does it. I'm not doing it. Whatever it is, right? So anyway, all right, karma. It's a witch. So anyway. So just for the break, talking a little bit about the FOMC, and it's interesting because, again, in their statement yesterday, they made this very clear was, and this was I'll read to you from the actual statement. Participants generally observe that a restrictive policy stance would need to be maintained until incoming data provided confidence that inflation was on a sustained downward path to 2%. Now, that's a key statement. It didn't say that inflation has to be at 2%, right? And this is a mistake that a lot of people are making. They're going, well, the Fed's going to hike rates until we get to 2%. That's not what they said. They said that it's got to be on a very clear, sustained trajectory to 2%. So, in other words, we go to 7 to 6 to 5 to 4. You've got a very clear trajectory that at that point you're probably going to be heading back to 2, right? So again, it doesn't mean you have to wait till you get to 2, but they just want to see that inflation is coming down to 2% and not just basically pausing before it runs up again, right? So that's the big thing, which was likely to take some time in the view of the persistent and unacceptably high level of inflation. Several participants commented that historical experience cautioned against prematurely loosening monetary policy. Now, that's cutting rates and obviously reversing QT, right? So that's the big thing that everybody's kind of focusing on. So, this is that whole idea that come July, the Fed's going to be cutting rates. Now, the important thing here is to understand is that if the Fed is there's a huge difference between the Fed pausing rate hikes, right? So in other words, they hike to 5, 5.25, 5.5, whatever the number is ultimately going to be, and stopping there and just holding it. That's one thing. It's another thing to be cutting rates, because if they're cutting rates, it means that something has happened economically or something is happening financially in the markets or in the credit market, whatever it is. But there's a problem, and they've got to start cutting rates to try to get money moving back into the financial markets to help heal up whatever is now broken, right? So the only time the Fed is cutting rates is when there's a problem, and either you're in a recession, you've got some type of event going on financially or credit related or something else, right? But there's a problem, and that's why the Fed's cutting rates to try to ease monetary conditions, right? So right now they're trying to tighten monetary conditions to slow consumption, to slow economic growth, reduce demand. That brings down inflation. If they're cutting rates, there's a problem. So again, probably not something that I want to be investing in when the Fed starts cutting rates. That first rate hike or first rate cut, is probably not the time to be buying stocks. Mike, what do you think?
Absolutely. And I put out my article yesterday. It's basically the 3 paths ahead. And earlier we talked about how the market and Fed are diverging in their views. The market thinks the Fed will just gently lower rates towards the end of next year. The Fed thinks they're going to stay the same. I can see the Fed's scenario playing out. If the economy kind of stays intact, the markets maybe are lower, but they're not collapsing. If there's no financial instability issues and inflation doesn't fall rapidly to towards 2%, then yeah, the Fed path may have some validity. I struggle with the market's path that the Fed will do 25 basis points in, say, August and another 25 in November, December, a very gradual decline in rates. That's really never happened. Really, in reality, what happens is the Fed aggressively cuts rates because they're dealing with what we keep saying is something broke.
Yep.
And I think this time will be like the past. Hopefully the market's right. Hopefully this is a very gradual cutting of rates because the economy is stable, because the markets are stable, because there's no crisis on hand. I hope it's right, and that they can eventually get inflation back down to 2%. They can get interest rates back down towards, kind of closer to where they've been, and they can keep the economy afloat without losing jobs. That's great, but that's Goldilocks. That's not the way it tends to work in the real world, and we can all hope that happens. But in reality, we have to understand what's happened in the past. And again, in the past, there have been severe cuts to Fed funds to bring rates down rapidly. And in Bernanke's own words, severe cuts to Fed funds to juice the stock market. Not, he didn't say to juice the stock market, but to push stock market higher to get people to bring up sentiment about the economy, to create spending in the economy. So, this is the Fed that has to, their goal this year is to babysit market expectations, and I think market prices.
Yeah.
And if the economy and if all these things can work to their favor, maybe this happens the way Goldilocks would like it to happen, but
but history says that hasn't been the case ever.
Exactly.
It's and look, and if you don't really kind of believe what Mike's saying, all you've got to do is pull up any chart, and there's just thousands of them on the internet right now. Just pull up any chart of historical Fed rate hikes, and what you'll see is that rate hikes, unlike the stock market, they say that bull markets are basically the escalator up, and then bear markets are the elevator down. Well, with Fed rate hikes, it's the same way. It's this this gradual increase in rates until something breaks, and then it's an elevator ride down in rates. And to Mike's point, the drop in rates back towards a new low, and every time since the late 1970s. Every time the Fed has cut rates, they have cut rates to a new lower level than where the previous low was. So each and every time, rates had to come down to a new lower level to get the economy going again. And then when they hiked rates, the rate hike was to a level that was lower than the previous previous peak of rate hikes. This is the only difference this time, is that you can't go lower than zero. We were at zero at the last drop in rate hikes. So again, when we drop rate hikes this time, it'll go back to zero. But I don't see how we get to negative rate hikes. I don't think we get there. We're going to get to zero. But there's going to be a lot of other problems at the point. But it'll be a very sharp, rapid drop in those rate cuts to get back to zero. It won't be, to Mike's point, 25 basis points here, 25 basis points there. That's not going to be the way it works.
And Lance, when were we last at zero? Do you remember?
Yeah, in 2019.
No.
Yeah, because we came out of 2018. The Fed was hiking rates.
March of 2022.
Oh, yeah, that's right. That's right. Last time we were, that's correct. March of 2020.
10 months ago.
Yeah.
Not even a full year ago, rates were zero. Now they're 4.25%, 4.5%.
I got you.
That's how quickly the Fed brought up the Fed funds rate. And there's we keep talking about a lag effect. If that lag effect is a year, and we can debate this all day, and people do, then we haven't even fully felt that first 25 basis point rate hike from March.
Mm-hmm.
Now we can start talking about all those 75 basis point rate hikes that clearly haven't been felt in the economy.
Right.
And these lag effects, which we drone on about, and I know it's probably irritating to hear about, but this is the reality, is that the pain, the economic and financial pain from those rate hikes is just starting to be felt. The first 25 basis points, raising it from 0 to 1/4, is just being fully affecting the economy. There's still a whole bunch more to go. Every 6 weeks from March, they were raising rates.
Yeah.
And those are just working their way into the economy.
Well, and really, this is a conversation we'll pick up on the other side of the break. But so from a portfolio management standpoint and from an investing standpoint, right? So here I am. I'm sitting on a bunch of cash right now. What do I do? I mean, it's at some point the market should rally, right? I mean, the bear market will be over at some point, you would expect. But again, how do you navigate this issue as you move into the new year with all these kind of headwinds, right? So we've got quantitative tightening. We've got the Fed still hiking rates. We've got the lag effect from these rate hikes. We've got monetary impulses, right? The M2 money supply has dropped just drastically here because of all that kind of fiscal injection that we put in the economy in 2020, 2021 has now come out of the economy. So it really doesn't seem like a great environment to be aggressively bullish in, but this is usually the time when markets kind of surprise you too. So we'll come back and talk about that after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you as worried about estate taxes as we are? Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon, with the ins and outs of family limited partnerships for your estate and tax planning. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. Michael Leibowitz joining me. So the big question, right? So we're talking about the Fed and what the Fed's doing. And of course, the Fed is, hiking rates and extracting liquidity from the markets at the same time that they're pulling out liquidity from the markets. We've got, inflation running at 7% plus, and, earnings are coming down. We're facing a potential recession. Our portfolio is positive for the year. It seemed like right now we should just cash out everything and just go sit in cash for this year. It doesn't really seem to be a lot of opportunity. But, the interesting thing about the way markets work is that despite all of these obvious headwinds, markets have a tendency to surprise you sometimes and do things that you don't expect to move. Again, we've laid out a very bearish case this morning, really, for the markets from what the Fed's doing and what's heading. It seems like as I said, the obvious thing is like, why even be invested, right? Just go sit in cash. Well, the problem with that is again, there's been a lot of damage to the markets in terms of stock prices. Meta down 50-60%, Tesla's down 60-70% from its peak. I mean, a lot of stocks have really, really taken a beating this year. Small caps, mid caps, large caps, to a large degree, have all taken pretty substantial hits. Yet the market overall hasn't come down that much. Market's down about 19% from its peak. So again, it seems like a bear market. It feels like a bear market, but markets have really held in a whole lot better than you would have expected, I think, in an environment where the Fed was aggressively hiking rates. I think at any other point in history, if markets were operating on a fundamental basis, rather than this kind of passive indexing environment that we live in, markets would have been down substantially more than where they are. We would have probably been talking about a market down 30 or 40% rather than 19% last year, actually 18.1% total return basis last year. So, that's the challenge here for investors. And, how do you allocate money to the markets and try to participate here in an environment with such obvious headwinds, but where a market, because of passive index flows, and again, ETF flows last year, very strong. People put a lot of money into equity ETFs last year. Despite the fact of what market was going on, we haven't really seen that capitulation of what we would normally deem a bear market. In a bear market, nobody wants to own stocks. In this environment, we've had just record inflows of money into passive ETFs because people are convinced at every moment they don't want to miss the bottom if the Fed pivots, so they keep putting money into ETFs hoping to catch the bottom. And that's a very different environment that we're in. And this is what's going to make a real challenge this year into managing money. Again, you can take the opportunity and say, I'm out, I'm just going to sit in cash, and this market can take off running because, again, the markets are pricing in what the Fed is doing. The market is trying to front run what the Fed is doing. The market is trying to outthink the Federal Reserve and what's going on economically. They're pricing in expectations for a reduction in earnings. They're pricing in an expectation for a recession. That's all being done psychologically. There's so much talk about a recession. There's so much talk about Fed rate hikes and all these type of things. The market's already adjusting for all of this. And again, this is going to be one of the most forecasted, predicted recessions if it occurs in U.S. history because everybody's talking about it, which brings up the risk that the markets can do something quite unexpected and start to rally much sooner than would make logical sense. And this is one thing that's going to be a big challenge for both Mike and I to manage money this year is how to navigate this market. It's going to be a year, I think, with a lot more volatility. Mike, your thoughts?
Yeah, I think this year is going to be much harder than last year. We started last year, day one of last year, we had a high level of equity exposure. And day one, we started reducing our exposure. I think we pulled off 6% of our exposure on that very first or second day of the year. And the reason for that was because we thought the Fed would start raising rates, that they had to combat inflation, that inflation was on the rise. And look, we didn't expect the Fed would get up to 4.25%, but we thought that we'd be going into a tightening monetary policy regime. And that's what happened, and stocks trended lower. And we had reduced exposure throughout the year, equity exposure throughout the year. This year seems difficult because, like you said, passive flows have not stopped. So one of the things we have to keep in mind is, will something happen this year where passive investors, where individuals say, you know what, my 401k, which right now gets 80% of my contributions to stocks and 20% to bonds. Bonds are at 4 or 5% now. I'm going to switch it to 50-50. Or, you know what, stocks are going nowhere. I'm just going to get out of stocks. I'm going to go to cash. Like you said, I can earn 4%. So the first question, or first thing that we always have to keep on the top of our mind is it possible that those passive flows into the market that just are coming in every other week, every time someone gets a paycheck, that they will reverse, that that flows will leave equities and go to cash or bonds or commodities or wherever else they may go. So, that's top of mind. But I think this is the year we kind of prepare for the worst, hope for the best, and reality will be somewhere in between. The Fed is telling us they're going to raise rates through March, April. They're going to keep rates where they are. The lag effect of all those rate hikes from last year will just slowly work their way into the economy. We're seeing some decent deterioration in economic data. It's just not in labor data. And I think the Fed wants to see a weakening of the labor market because their biggest concern is Paul Volcker's from 40 years ago, that inflation comes down and then pops back up again. They had 3 waves of inflation back in the 70s and early 80s. And I think the Fed's biggest fear is that they take their foot off the brake too soon and inflation comes back. With that, their credibility falls. And with that, stock prices get hit much more. Inflation could rise more than it did out of fear and concern from consumers that inflation isn't a one-time event because of the pandemic, but now it's become part of the economy due to monetary policy, fiscal policy, and just consumer behaviors. So, I think this is a year to be very careful, to expect a lower trend, but to understand that just because we expect a lower trend, stock prices can't go higher. And you know, while we may talk a lot about a bear case, Lance and I spend 75, 80% of our time talking about where's the bull case? Where are we wrong? Why would the market go higher? What could cause it to go higher? And I think you need to keep your head on a swivel, and you need to think about where your thesis is right and where it's wrong, and adjust that thesis. What we're talking when we're talking in 2 months in March, we may have a completely different view, and stock prices may be a lot lower or a lot higher at that point. Inflation may have come down or is being stubborn, and the Fed may be doing something completely different than they're doing today. So I think the word of the year is going to be audible. We have to be ready to be audible and know what we're audibling into.
Yeah.
We have to have 4 plays called, and we're at the line of scrimmage every day. Yep. And maybe the first play is not the play. Maybe it's that second or third play that we have to audible to. Mm-hmm. And I think that's going to continue through this year. It's going to make it a very challenging year.
Yeah. And again, there's a lot of, media headlines out right now about there's never been 2 down years in a row. And a lot of that has to do with calendar quirks. So you've got to be really careful with that type of analysis because, bear markets start, markets are up, 10, 15%, whatever. And then the market starts declining in the beginning of one year, doesn't get to a negative return, but the bear market actually started in the year preceding whatever negative year and a half, but it's kind of a calendar thing. But again, there's only been a couple of years or a couple of periods throughout history where there's been 2 negative years in a row. So a lot of investors kind of hanging their hat on. It's like, oh, this year will end up positive because there's never been, very rare there's 2 negative years in a row. Just be careful with that. Like Mike said, it's possible. Again, we could be talking about the resumption of the bull market later on this year. I, just don't know. But the question I think really comes down to the fact is, do we have a recession? How deep is that recession? And more importantly, do earnings and estimates for earnings, most importantly, revert to some level of normality where valuations and prices and earnings, going forward kind of get back into some level of reality that are sustainable. So, to Mike's point, it's just going to be a year where this month we're talking about, being mostly in cash. Next month we may be talking about having a lot of equity exposure. It's just going to be a year where dynamics are going to change. What worked last year may not work this year. A lot of people piled into energy last year because it was working. Something that Mike and I had talked about on the show back in November of 21. We talked about increasing our energy exposure because it was so hated. That was the sector that everybody hated, and it was a huge winner. It was up 40% last year. Markets were down 20, right? So that's a huge outperformance. Probably not going to happen again this year. So, it wouldn't be surprising at all to see energy underperform. And then, of course, you start looking back at what's most hated right now, which is technology and consumer discretionary. Those are the most hated stocks right now. Maybe those are the big winners this year. Maybe they start getting some inflows this year because of changes to or realization that maybe things aren't as bad as everybody expects. I don't know. But Mike, closing thoughts. You got 10 seconds.
Keep your head on a swivel and be ready to audible.
There you go. All right. Get by the website, realinvestmentadvice.com. Send us your questions, comments, emails, as always. And again, we'll keep you updated on what we're doing. As we make audibles, we'll let you know. But again, our daily commentary is out this morning. Make sure you're subscribed. We send out a daily commentary every day. It's a quick read, about 3 minutes. We give you a market trading update, interesting tidbits about the markets, and more. It comes out every morning at 7:30. Subscribe at the website, realinvestmentadvice.com, and we'll see you back here tomorrow for Financial Fitness Friday with Danny Ratliff, Richard Rosso. Before the bell, coming up in just a few minutes. Don't go away.